It's Sunday the 14th of January 2018. I wanted to talk about something other than gold and gold stocks today, and that's uranium and some of the uranium plays on the ASX. Um, the main one being Berkeley Energia, the code's BKY, and I hold the stock. Uranium being a absolutely terrible market. This is a chart that I pulled off online, and it's showing some of the macroeconomic events and how uranium's fared in the last sort of 40 years. And you can see it's a volatile market. There's not many more volatile markets than uranium. Even gold is not as volatile. As depressing on the downside, which this since. So the main thing that's been after the massive bull run in the mid 2000s in uranium, we had Fukushima in 2011, and we're down. The uranium price is down from sort of $80 a pound to about 20 bucks a pound now, and that's those levels are just completely unsustainable on a long-term basis. Those price levels, something like 80 or 90% of the world's production is underwater at those prices on a cash cost basis, and it's sort of to actually get the uranium market back to a level where a lot of companies are actually making money. The uranium price has to go up to sort of $60 a pound roughly, and to incentivize new production, it's even higher than that, sort of $70 to $80 a pound from what I've read. So it's a market that's been in complete liquidation for some years now. The other thing, and you can see on this chart, it's got reactor growth expected to increase. There's actually been, aside from the Japanese who have had a lot of their reactors shut since Fukushima, there's a lot of new demand from reactors in China, in India as well, and a few other countries scattered around the place. And there's more and more reactors being built. So while some of the Western countries are closing reactors or have plans to close reactors if they can to meet some of their environmental groups lobbying, for example, there's been a general those new countries are outweighing the reactors that are shutting. So there's a general increase in demand expected in the next 5 to 10 years. It might be easier to, so this is the uranium ETF, the uranium stock ETF, the URA, and this is it's a relatively small ETF, so it's not necessarily a great representation of the market, but uranium in general is a small market. But you can see here, since this is Fukushima here, so since the top in 2011, this index is down almost 90%. So it's trading at 15 now, and it was up at 130 in 2011. So this is just, a lot of these companies have been completely obliterated. If people have followed something like Paladin, which I think I held probably in about 2012 or so, and traded out of a loss, that they went bankrupt. So they're pretty much finished, I think now. So it's been a slow decline, and a lot of other uranium producers are in the same boat. So why am I getting interested in it? In particular, a couple of things. Of late, there's been some really large production cuts by Cameco and by the Kazakh uranium authority, Kazatomprom, and that's looking like cutting about 15% of next year's uranium supply out of the market. And there's been a few false dawns in this. Even in the start of 2017, there was a lot of money that started to come into this URA ETF when there were production cuts announced. But this time, I think the volume of the size of those production cuts, and just how long the market's been in this decline, I'm thinking that it's not a false dawn this time, and this is the time to really get interested in these uranium companies. One of the quotes I found, this guy's not bad on Twitter. Posts a lot of uranium-related material, and he's got Doug Casey here, who's sort of renowned resource investor, and he's sort of comparing it to gold stocks. So it's sort of like a lot of the stuff I'm doing here. When the market wants into gold stock, it's like trying to force the contents of Hoover Dam through a garden hose. In the case of uranium stocks, it's more like a soda straw. It's a very small market. So that sort of brings me to, if you want to play this, how do you play it? I think from what I've read, I think the number of uranium stocks on the ASX is about 10 or 20% of what it used to be ten years ago. So because the market's just gone into complete liquidation, there's very few left. There's a few people sitting on projects, and the one that I'm sort of putting my money into is Berkeley Energia, which is the largest. I think it's now the largest uranium developer on the ASX. You still got companies like ERA left, and there's a few other development companies. But Berkeley, they're building a project in Spain. It's fully funded now. They got a commitment from an Omani sovereign wealth fund to buy in and debt fund that project. So that's kind of a unique deal. But their costs of production are very low, and they're one of the few that could make money, not a lot of money at these uranium prices. But as I said, I don't think uranium prices are going to stay at these levels. One thing to be aware of, uranium is of a reactor's actual operating costs, the actual material, the fuel, is a very small portion of their operating costs. Something like 5% of a reactor's operating costs are actual uranium. So they don't really care what the uranium price is. They will be buying when they need it. So they haven't needed it for the last 5 years because the market's been oversupplied. No projects have been getting built though. So at some point, with those new reactors coming, the market is gradually going to shift into an undersupplied position, and a lot of that demand is on long-term contracts, which are now expiring. A lot of those contracts are sort of set in that 2007, 2008. So some of those reactors are going to start coming into the market to buy new supply, and it's once they've eaten through the stockpiles, there's not a lot of supply there, and there's no new mines coming online except a couple, one of which is Berkeley, and their project's sort of slated to come online probably early 2019. But I like this. I like the stock. It's got only a relatively small number of shares in issue, about 200 million. Very illiquid. You can see it's moved up. This was when Cameco announced their production cuts in November, and you can see the stock moved up about 15% in one day, and it's since sort of come off a little bit. But I think there's some real this is a really good opportunity to be buying here, and that's what I've been doing around this sort of low $1, sort of high 90s level. And I think it's likely to go higher. Some sort of sort of ranges here. It's this sort of mid 70s level is the probably I guess the support level that sort of held in 2016 and 2017, or just 2017 mainly, but and then the upper resistance level is around that $1.35, $1.40, which is the Fukushima level. So you can see on the chart that's just colossal volume that came in that sort of week or two, and that's where we've been trading for the last sort of year. So we're still being kind of governed by that selling event and that Fukushima event in general. But I think for all those sort of factors I've stated, uranium is a really sort of contrarian play at the moment, and there's not a lot of good companies. So when that, as Doug Casey said, when that money comes in, it's going to push up the best uranium companies a lot higher, just because of the lack of money lack of opportunities. So I think people will be looking for those companies that are well run, have decent projects, and are fully funded to production, and that's where Berkeley comes in. So this is one of my plays in 2018. Sort of been buying since mid 2017, sort of below sort of 85 cents. So I'm thinking it's quite it seems very well run company. Haven't made many mistakes so far, and they're in that construction phase in Spain, which is a relatively good jurisdiction for mining. There's still a little, there's occasional environmental groups and stuff, but no different from many Western countries, including Australia. So I think, they seem to be doing everything right, and the uranium market is setting up for a decent move. I'm not saying it's going to have that, one of these runs back up to, $120 or $150 like it did in 2007, but even if it rallies back to a sort of a level of $65 a pound, for example, that's a 150 to 200% move from where it is now. And I think that will, if the uranium stocks normalize with that move in the uranium price, you could see something like Berkeley trade, well above its all-time high there of around 220. So that's the one I've chosen. There are a few others like Toro Energy is another that's had a project in WA for a long time, sort of sitting there. It's moved up. It hasn't really moved in the same way as something like Berkeley. Still sort of making lower lows. Um, there's Boss Energy as well, which has bought a project in SA in South Australia, and it's in I think in about 2015, or they bought that project maybe a bit later, and it's on care and maintenance, but they're trying to redevelop that and sort of restart it with a higher production base, as I understand it. So they're another one I looked at, but these, I don't like to trade companies that trade at sort of 5 cents and just have that huge probability of having to raise capital and just dilute shareholders further. So I like something like Berkeley, where they've got that sort of critical mass and a good shareholder base now, where the price can go higher. So that's uranium and Berkeley, and something that I'm following in 2018, which I think is this is the right time to enter after a 5 to 7 year bear market. Basically, a whole cycle in uranium projects. A whole cycle of where projects should have been getting developed has been skipped, and that's in the next 3 or 4 years. That's going to create issues for uranium supply, and I think when these companies move, they move extremely well, extremely volatile companies. So that's what I'm following in uranium in 2018.